All right, what's going on, everyone? This is now episode 5. It is a beautiful day outside and another great opportunity to learn about stocks and investing. We've made some solid progress so far. I'm really excited to say that we are so freaking close to 100 subscribers on YouTube. This was kind of one of our first objectives. Very humble to get started, but I think incremental progress is important, and this is a great example. We are so close. So keep on sharing, keep on liking, and subscribe if you enjoy the content. It means a lot, helps the channel grow, and it helps us reach more people so that they too can learn some financial independence, strengthen their skills, and expose themselves to new investing opportunities. So with that, last episode, we dove deep into Warren Buffett, his legacy, his business, and the financial performance of Berkshire Hathaway. I also told you how much I think the business is worth and where it's trading at today and whether I think it's a good investment. So if you want to check out and learn more about Buffett and Berkshire Hathaway, definitely go watch episode 4. I highly recommend it. And with that, what is today's episode about? Well, last week I talked about that it is a very exciting time for investing and for myself personally because a ton of businesses release their 10Ks and their annual performance for the past year. I update the financial performance of all the businesses I track on an annual basis and add it to a long list going back more than 10 years for most companies. This gives me a great picture of how the business is performing, and they tend to release this information in the first quarter of the new year. And so you can kind of see that here in the very first column. I have highlighted which quarter the financial results are released. And as you can see, there's a lot of blue. If I scroll down, tons and tons of blue. And this is something that's very important. It gives me a new picture as to how these businesses are performing, and it will blow up this list. It will change the ranking, the order, the position of all these companies, show me where companies are continuing to sustain their leads and also where maybe some have regressed. Now, what I said is that I think these numbers are going to come out over the next month. Typically, barchart.com releases the financial results about a month after they have been officially released. And so we are just waiting right now to track and then add all those numbers. But on top of that, I realized that if I want to give you guys the best exposure, and not only you guys, but me as well, to as many high quality companies as I can, then I am going to want to add to the list. Before this video, I had about 88 companies I was tracking. And I said, if you really want to see how clearly companies are performing and if they truly are the best, then you need to expand that list. And so what did I do? I added another 80 companies to this list. So if I scroll down, you can see a bunch of blanks. Some are already filled out, but there are now going to be, following into next video, 161 companies on this list for you to track, for me to track, and for us to see who truly is the best businesses out there. Now, that said, it takes a lot of time. A couple of these companies are listed on here, but it is going to take a little while. And I promise that for the next video, I'm going to have this full list complete so we can truly dive into it, review everything, and see how these companies are performing. On top of that, I also want to show how I actually found these companies, because 80 high quality companies that are all profitable and all growing at a good clip is, you would think, is more difficult to find than it really is. But I'm going to show you exactly how I do this in the next video, where I found all these businesses and how you can replicate it so that you can do just what I did and really expose yourself to high quality businesses. Now, the caveat is I need to hit a certain benchmark, and I'm asking for your help in order for me to reveal this information. If we can get at least 20 likes on this video, then I will share that entire breakdown. I will give you the exact information I used to find 80 high quality companies. And I guarantee you that these 80 businesses are above average and willing to outperform the S&P 500 on their own as a collective. So how did I do this? Well, let's tune out in the next video. But for now, what are we going to focus on? Well, I thought this was a good video and a good episode to really dive into the businesses that are already on the list, see where their rankings are, reiterate why I track certain things and prioritize certain metrics over others, and give you a full picture. We will talk about a bunch of the companies that I've already tracked, and we will also see their valuations, what I think they should be bought at, and then you can go from there and determine as you will what you think is a good investment. So with that said, where are we going to start? Well, I'm going to give you a breakdown of each of the financial metrics here, kind of explain why I track them, where their priority stands, reiterate that. We'll go into value, and then we'll really dive into a list of each, the top 10, top 20 of each, and you can get a holistic picture and really see where things are at. So why do I do this? Why do I track these companies? Why do I do it the way that I do? Well, as I've reiterated in all my videos, is I care a lot about quality. I want to find the best businesses, companies that are fundamentally strong, that have really good financial performance, strong economics, and they're positioned well within their own market. They are the top players in those markets, and they are built to last, they are built to grow, and they are built to build an enduring, sustainable business for many years to come. On top of that, you got to tie that in with the valuation. You don't want to just buy any stock at any price, because oftentimes that ends up hurting your performance over the long run. There's a great saying by Howard Marks, one of my favorite investors, who says that it's not what you buy, but the price you pay. And so, yes, quality matters a ton, but if you don't pair it with a valuation that is attractive, then you're only ending up hindering yourself. And we want the best of both worlds. We want to find those dual catalysts between quality and price that can really set us in a great position for the long run and generate meaningful returns that are above average, well beyond what the S&P 500 can produce and the like. And so that is what I do here. I pull certain metrics that I believe are very good indicators of that fundamental strength, and then I compare it to the valuation of those businesses, and we want to see how those work in line with each other and where a business lines up both between quality and value. So going from left to right, what you are seeing is a ranking system. This will show you from 1 to eventually 161 where companies stand on an overall basis, but we can also use this ranking system to just essentially show and highlight where certain businesses fit within the grand scheme of things. So moving next, obviously we have the company details. So Euroseas is number 1. We got the ticker there, ESEA, and then the industry that they operate in. Euroseas is a shipping company. They fit within the transportation industry. From there, we have the financial metrics that I track. These are the four most important financial metrics, and then I have 2 valuation metrics that I priority above all else, and this is why. So return on invested capital. Number 1 most important financial metric that you can track from a company. It is essentially telling you how well a company is able to use all its assets and the debt that it takes on to generate a profit. The more profit it generates with those assets and debt, the higher the return on invested capital. I track it over a 5-year average because you don't know what's going to happen in any single 1 year. Things can fluctuate variously for many reasons, and you don't want to limit yourself to just that scope. Expand it to 5 years, you get a more longer term picture of what they're actually able to produce and how consistently they can produce it. From there, I track profit margin, another really strong indicator, especially within a company's market. If they're generating above average profit margins relative to their peers, then that is a really strong side, but also as the market as a whole. You will get a really good picture of the economics of different businesses. So you'll see that many software companies have higher profit margins because it requires a lot less money to go in, many less expenses to actually generate those profit, whereas something that is much more tangible, has a lot of physical assets, say it's a transportation company or a warehouse or manufacturer there, oil refinery, their margins may be a lot smaller just because they have to maintain all those assets in order to generate a profit. Something to consider. Both types of businesses can be very valuable, but ultimately, a higher profit margin just means that you are capturing more dollars, you are bringing more money into yourself that you don't have to pay outward, and that's always a good sign. The wider the margin, the more protection you have from bad times, uncertainty, and you can also really compete against your competitors at a higher level, a higher clip. From there, we look at the long-term growth rate. So this is a weighted combination of the 3-year, the 5-year, and the 9-year growth rates of revenue, net income, book value, and free cash flow. I track those, I combine it and blend it into one overall growth rate that highlights the long-term performance. It's a useful metric. It's going to tell you how quickly the business is growing and if they can sustain it. And really, the general rule of thumb is if you can find above 10% on a growth rate, it's a pretty solid indication that the business is growing at a good clip and continues to have a long runway ahead of them. I'm going to skip free cash flow yield for now just because it is a valuation metric, and we'll move on to debt to free cash flow. So this is on a single year basis. All I'm essentially tracking is how much debt the company has relative to its last year of free cash flow. What you want to see is that if the number is below 100%, it means that they could essentially pay off all their long-term debt within a single year using the free cash flow that the company brings in. Beyond that, it may take a couple of years, maybe a year and a bit if they really wanted to. But what it's showing more than anything is that they are in a good position. They are bringing enough money in that debt is not becoming a burden. It is more of an asset that they can further use and enhance the business without threatening bankruptcy or the business going under. So those are the 4 financial metrics: return on invested capital, 5-year average, profit margin, 5-year average, growth rate. This is a long-term average. And then we also have debt to free cash flow. These are the 4 most important. I believe that in this order, this is how they rank. So return on invested capital, number 1, profit margin, number 2, debt to free cash flow, number 3, and growth rate, number 4. So gives you good idea of quality. I think that's all you really need to have a good glimpse into how fundamentally strong a business is. And it is a great comparative tool against other companies as well. From there, talk about quality. Now it's on to value. So I got 2 metrics here. First is free cash flow yield. So again, this is on an annual basis. And what I'm doing is I'm taking 1 year, the most recent year of the company's full year free cash flows, and I'm comparing it to the business's market cap. So the higher the yield, the higher return you are expected to get if you were to purchase the business at that price today. Because what it is essentially highlighting is that if I bought, for example, Euroseas at a market cap of 377 million, well, based on the free cash flow they produced in the last year, which was about $130 million, that you would generate about a 33% annual return at this price. Of course, they got to be able to sustain it. They got to keep growing the business and be able to maintain this. But right now, it is a strong indication that the business is undervalued or producing a higher return than the market is realizing, and maybe investors, maybe Wall Street should key onto this business a little more. The other one is an over-under. And so what this essentially is doing is within this row here, column Q, what I have done is figured out the price, the holistic intrinsic value of the business, what I think it is worth, what you should pay for it. And if the number and the column just next to it to the right is negative, that's essentially showing that the market cap is below what I think the company is truly worth. The business is undervalued. Now is a time to really look into it. It should pique your interest, and you want to consider maybe making a purchase at this time, because it is the combination of quality as well as price that is making this business highly attractive. So with those 2 valuation metrics and the 4 quality metrics, these combined produce what I build as my ranking system, and it allows me to measure businesses on a way that really takes into all the pieces that I think are most important in determining a good investment. Now that we've kind of covered how and why I actually track these things, now it's time to really just dive into each of the specific areas. We are going to look at each of these on an individual basis. I'm going to list out the top 10 companies from each, and then we can kind of talk about them a little more, what I'm expecting to see into the future, and then where we go from there and determine the final results at the end that showcase and highlight the best businesses of all. And with that said, the top 10 companies by a 5-year return on invested capital are: number 1, Apple with a 65% ROIC. Number 2, Medifast with a 58% ROIC. Number 3, Alta with a 48% ROIC. Number 4, MasterCard with a 47% ROIC. Number 5, Fortinet with a 46% ROIC. Number 6, Dollarama with a 41% ROIC. Number 7, Nvidia with a 40% ROIC. Number 8, Moelis with a 37% ROIC. Number 9, ASML with a 37% ROIC. And number 10, D-Local with a 37% ROIC. And even as we go further down the list, you can see a bunch of different companies that even have above a 10% average. And really, Warren Buffett always said that if you could find companies with above 10% return on equity, which is an even less conservative metric, then you have found a good business. So that even speaks a lot further when it comes to return on invested capital, much more conservative metric because it incorporates debt, whereas return on equity doesn't. But you are seeing some very interesting companies here. Apple, for example, is one that I've spent a lot of time looking at and wondering whether it was a worthwhile investment. Clearly, the company has exceeded so many expectations, and over the past 25 years has grown at a tremendous clip, especially following the launch of the iPhone back in 2007. And now they're at a market cap of $3.8 trillion. It is a phenomenal number. And what you'll see is if you look at the business on a closer level, Apple is growing at a slow clip right now. They're growing at 4%, and that just speaks again to the size of the business. There's only so much money out there in the world that you can capture and that consumers are willing to pay for. And Apple is a company that is mature. Their products are kind of becoming repetitive. There's not a ton of innovation coming from the business, definitely not as much as there was in the early 2000s. And you're seeing that reflected in the growth rate. But since we're talking on return on invested capital, what are they doing? Well, the business is generating a ton of profit. And over the past couple of years, you'll see that they've actually been shrinking the amount of shareholder equity that they hold within the business. So how does that actually operate? Well, what they would be essentially doing is they're selling down the amount of assets that they have while still being able to generate high levels of profit that you would expect and hope from the company. And this has really grown their return on invested capital over the past couple of years. 65% is ridiculous. Now, it's just one of those things that this is where valuation is very important, because you would say, and I would even argue, that just based on this number, you would want to own Apple. Like, no company comes even close. And again, this is a lot of high quality businesses tracked here, but this is clearly an outlier in its own right. The only thing is that it has a $3.8 trillion market cap. And I really think the company is worth about $900 billion. So that's showing that it's right now 325% overvalued. The free cash flow yield similarly reflects this. You would only generate about 3% at this time. So what does this mean? It means that while one single metric can be very important and useful, and this is clearly the most important to me, there are other factors that you want to gauge, and you don't just want to jump to investing in a business just because, say, a certain metrics hits, or maybe there's a growth opportunity within the business that they've listed out. You want to look at it at a very holistic picture, see where they're at, understand the size and scale of the business. A $3.8 trillion business is not going to grow as quickly as a company that's only a $300 million market cap. There's just not that much room to expand. They're already at the top of the market in the world, one of the biggest companies, and arguably the biggest company, I think, next to Nvidia and maybe one more. Maybe it's just Nvidia there, but it's in the top 3. And so for it to expand to $7 trillion, $15 trillion, it just is a lot less likely, especially with their size, the maturity. The business has been around for nearly 50 years at this point, and it's just a question of, in order to get to that next phase, Apple needs to be able to create, innovate, and build products that are new, refreshing, but also maintain their identity and allow them to generate even more profits further. They have one of the greatest cash cows in terms of the iPhone. Like, I don't think there's any hardware product that has ever been produced that is as successful as the iPhone. But you got to find that next thing. They've been running on the iPhone for now almost 20 years at this point. And what are they going to do that is going to take them to that next stage of growth? Still very good, but definitely something to watch out for. Now, going on to Medifast. This is a health and wellness business that essentially what they do is help people lose weight. And it's actually one of the more interesting stories that I can dive into a lot deeper at some point into the future, because it's also the biggest mistake I've made as an investor so far. What I saw in Medifast was a super high return on invested capital. Their profit margin was much higher a couple of years ago, but they've continued to look extremely undervalued. And even at the time when I actually purchased the business, they were trading at about a $400 million market cap, well below what the company has been valued on my list. Now, here's the problem, is the moment Novo Nordisk came out with Ozempic and Wegovy, it essentially sent Medifast in a death spiral. And this is one of those times where, as you own businesses, you want to evaluate against all the market factors and see if a business can endure, if its business model is set up for success over the long run. And what this highlighted is that the business model was much weaker than I had originally anticipated, because as soon as those weight loss drugs came out, they essentially blew up the market. It was a quick, easy solution that a lot of people grew onto, celebrities grew attracted to, and it makes customers question, well, why would I need to take on a more effective diet? Why should I follow this program and embrace this product when there's a solution out there that's far more efficient? And that's exactly what happened. So while I thought that Medifast had an attractive return on invested capital and it was looking extremely undervalued, and I ended up actually making a small purchase into the business, what it turned out to be was that the business model was a lot weaker. And what I'm guessing is that you'll see in the coming months, especially as we get these financial results for the following year from Medifast, is it's going to lose its ranking. It's going to fall down. I think this is one business that is definitely not going to stay as high up on the list as it is right now. And we're just going to have to hope that, maybe they are turning things around. But I ended up liquidating that position. I no longer hold Medifast. I didn't think the long-term durability of the business was attractive enough for me to hold on to, turn my direction elsewhere. Now, we can look at Ulta Beauty here, one of my favorite businesses. This is a makeup and cosmetics retailer. They have many stores all around the US and have really positioned themselves as the leading retailer. And you can see that in their numbers across the board here. So we're seeing a 48% return on invested capital. They have a profit margin of 10%, so solid, especially for a retailer where they own physical stores and bring in physical products. That's pretty solid. Growth rate of 14%. Free cash flow yield's not the most attractive here, but this has fluctuated. They have definitely been at lower points in price throughout the past year and before that as well. And so that's all good. But then on top of it, it has zero debt. So that's another fantastic thing. And even Medifast had that too, but zero debt just means essentially there is virtually no risk of bankruptcy, because you have no debt collectors coming expecting principal and interest to be paid. And if you don't have to worry about that, then you are definitely set up to be sustainable and built for the long run. Now, from a market cap standpoint, they're trading at about $30 billion today, and I think the business is worth about $18 billion, which highlights a 68% overvaluation. Now, I would say that anytime a company is within the plus 50% or minus 50% range, it means that it's still worthwhile exploring and even potentially making an investment, because for one, I do a very conservative approach to how I value businesses. I want to give myself as many protections along the way as I can to ensure that I am making good investment. And that is one of them, is using that conservative valuation. So it's not that this number is set in stone, but it is what I believe the business is worth. And that means that anytime it comes within that plus 50% to minus 50% range, anytime it's negative, it's really good. But within that, you definitely want to say, okay, maybe it is time to start considering whether I should make an investment or not. MasterCard, another really solid company and one of the premier financial instruments in the world in terms of how the trust that they've built between banks and retailers, or sellers and producers to consumers, And just simply being able to have a card that enables you to create transactions with a high degree of trust, ensuring that the money is transferred effectively. This is why MasterCard and Visa are so strong. And it is also why a company like MasterCard is able to generate such a high return on invested capital of 47%, but also a profit margin of 45%. Both absurd numbers. And again, like what you're seeing here is many companies with high production. And you may think to yourself, well, compared to some of these other businesses, or as you look and we go further down the list, you'd be like, well, like, why would I consider this when I can look at a company like Ulta or Apple or anything where there's a higher metric? And what it really comes down to is that these are all very high quality businesses. They all have their own characteristics that lead them as such, but it is this combination of them all that really makes them stand out and why I'm attracted and why I want to follow them. So just looking at MasterCard's valuation here, the company has a $492 billion market cap. I think the business is worth about $123 billion, so 300% overvalued. Again, when you are a top tier company, you are much more likely to have a higher valuation, and maybe it is detached from what the business is worth. And that's because a lot of people are following it. A lot of people know that MasterCard is a good company. They know that Apple is a good company. And so they stay invested, and many times people disregard price, which also hurts them. But you're going to notice that a lot more of these really top tier, well-known businesses have higher valuations, especially in a market like we're having today, where it continues to shoot up and we're near or at all-time highs. That's just what you're going to face. But hopefully at some point along the way, and it could be 5 years, it could be 10 years from now, something happens, a catalyst happens that ultimately leads the stock to crash or correct to a more attractive valuation, and then you can buy it at a reasonable price. But a company like MasterCard right now, based on their valuation, this would be a business that I would just sit and watch and update and track and see when there is a moment that the price becomes more attractive. Until then, I'm fine just sitting on the sideline, investing in other things at this time. Now, next up is Fortinet. Fortinet has a 46% return on invested capital, profit margin of 21%, as well as a 25% growth rate. And I'm going to talk about Fortinet a little bit more because it is one of the largest positions in my portfolio. They are the premier cybersecurity company in the West. They have essentially built the hardware, the software, the all-encompassing infrastructure that leads to a competitive advantage that protects customers at a higher rate. And this is demonstrated in their customer base. I will go into way more detail into Fortinet in one video where we really analyze the business and just focus on it. But what you're seeing is an all-around really high quality company. Debt to free cash flow, also quite low. They could pay it off in a year. And another attractive element is the company right now has a $58 billion market cap, but I think the business is worth about $96 billion. So that is putting it 40% below or undervalued right now. And it's continued. I started investing in the business over a year and a half ago, and it has generated solid returns since then. But even still today, it looks attractive at this price. One of my favorite businesses out there, one of the strongest companies in the world, I truly believe, an all-around company, and it has great long-term prospects because realistically, cybersecurity is only going to become more imperative as AI develops, as systems become more sophisticated. And while the good guys are out there protecting, ensuring that, files don't get corrupted, identities aren't stolen, there are also bad actors out there that want to seize that information. They want to seize money. You've seen the number of cyber attacks when it comes to crypto. Well, you need a good cybersecurity system that protects everything. Otherwise, you're going to run into trouble, and it can become extremely costly for an individual as well as a business, even a government. So with that, talked a lot about return on invested capital. We'll move on to profit margin now. As we talked about before, it is essentially the amount of profits you retain after all your annual expenses, your operating expenses are paid for. The higher the profit margin, the better. It is very market dependent or industry dependent. If you are a software company that has few physical assets or things that you must maintain and pay for, or that in the fact that you can generate higher profits using less money, that is always a good sign. That is what software is all about. But you'll see that a bunch of different companies here can produce higher profit margins. It also shows the strength of them within their relative market. And something definitely, it is the second highest priority on my list of financial metrics. And again, this is a 5-year average. So with that, the top 10 companies with the highest 5-year profit margins are at number 1, Visa with a 52% profit margin. Number 2, Euroseas with a 45% profit margin. Number 3, MasterCard with a 45% profit margin. Number 4, Bank 7 Corp with a 40% profit margin. Number 5, Taiwan Semiconductor Manufacturer with a 40% profit margin. Number 6, Texas Instruments with a 38% profit margin. At number 7, Regeneron Pharmaceuticals with a 38% profit margin. At number 8, Nvidia with a 37% profit margin. At number 9, Catalyst Pharmaceuticals with a 36% profit margin. And at number 10, Microsoft with a 36% profit margin. So a couple things to note. 1, there are multiple semiconductor companies in here. Even though like TSMC, for example, is a manufacturer of semiconductors, and they produce 76% of the highest quality semiconductors out there, they are still able to generate a 40% profit margin. And why is that? It's because every top company wants their chips. Nvidia is a major customer. Apple's a major customer. Anyone who designs their own chips and needs them manufactured to the precision that they are looking for, they seek out TSMC. And that is because they have mastered it, they have built the systems in place, and why they are able to retain it is because nobody else does what they do. But you are also seeing that other designers and manufacturers are able to generate high returns as well, or high profit margins as well. They just operate in different areas, but it clearly highlights just the importance of semiconductors, the value that people put on it, the premium that they are willing to pay in order to get the best products. And that is what you're seeing here. You're also seeing that Visa and MasterCard are very close and on par. So while I said MasterCard had a 47% return on invested capital, Visa's is significantly lower at 29%, still phenomenal. But here, Visa gets the edge with a 52% profit margin, whereas MasterCard gets a 45% profit margin. And the thing is that they essentially own a duopoly in this market. So there are no competitors that have, say, successfully broken into it over the years, and they've been able to sustain it. And so, like Visa and MasterCard, really strong businesses, that's clear. Another thing, they're still both overvalued. That's the tough part. So even though you're excited to see that, it's just one of those things that you got to wait on the sideline for them. But there are also many other companies out there with high profit margins. I've already talked about Euroseas. This is a company that we are invested in. I'm very bullish on them overall, and they have solid prospects. Growth rate's kind of their weak point, let's say, but they have operated and done everything right to be in that great position. And then on top of it, it's trading at 51% below what I think it's worth. So that's why I invested in it, but it's also a great business overall and something that I look forward to continue tracking and following over the coming years. Now, on top of that, interesting enough, you're seeing that a few of these newer players like Bank 7 Corp, Catalyst Pharmaceuticals, Axos Financial, they are all making their way into at least the top 20. And this is kind of the goal. This is why I wanted to do this, is because now you're seeing that there are even more companies out there with really high financial metrics like profit margin, and they can be compared against those that I've always tracked and really see and determine what the best businesses out there are. So something very interesting, profit margin, another really important metric there, something to look at, and one of my favorite metrics overall. Now from there, we are going to look at growth rate, and what we are seeing now are the fastest growing companies in the world today that have done it over a long enough stretch to give you a solid picture that they can truly do this for at least the near term, but continuing to grow at a solid clip into the future. Growth rate is the lowest importance of the 4 financial metrics because Growth can be achieved in many different ways, and it can often mislead you, but it is still a solid sign if a company is growing above 10% annually when it comes to their revenue, their profit, their free cash flow, and their book value. Then that is a great sign. You are seeing that a business has a runway that they can continue to benefit from. They have tailwind supporting that, and that they can continue to achieve higher than above average rates of return. Again, you got to compare it with valuation and the other fundamental factors, but something that is very attractive nonetheless. And so with that, the top 10 companies with the fastest growing long-term growth rates are: at number 1, CrowdStrike with a 67% growth rate. At number 2, Atour Lifestyle Holdings with a 64% growth rate. At number 3, Pinduoduo with a 64% growth rate. At number 4, NVIDIA with a 59% growth rate. At number 5, Shopify with a 41% growth rate. At number 6, Houlihan Lokey with a 36% growth rate. At number 7, Arista Networks with a 31% growth rate. At number 8, Axon with a 31% growth rate. Number 9, Palo Alto Networks with a 30% growth rate. And number 10, Salesforce with a 28% growth rate. So very fast moving companies. These are companies that are almost doubling their revenue, their profits, their free cash flow every single year. Anything above 10% is phenomenal. So you are seeing that these businesses are growing at an extremely fast clip. And what you'll notice is that for the most part, many of these companies trade at least below a $200 billion market cap, with NVIDIA being the exception. And I've mentioned NVIDIA on all 3 of these lists so far, which is phenomenal. What NVIDIA has achieved in the past 2 to 3 years when it comes to manufacturing these semiconductors and really supporting the AI boom, I don't think I've ever seen any business accomplish what they have. And that's why you're seeing a 40% ROIC, a 37% profit margin, a 59% growth rate with very little debt. The only caveat being is their valuation right now. They are a $4.5 trillion company, and I think they're worth about $2 trillion. So still one of the biggest businesses in the world. The big thing is that if you're paying at a $4.5 trillion valuation, you run into the problem of, well, are they going to be able to double to 9 trillion in, say, a 7-year period, which would be the same pace at least as the S&P 500? Do I think they can double to $9 trillion in 7 years? It's possible, but I think less likely. And so if for whatever reason NVIDIA regressed in price, it contracted down to that $2 trillion mark, I would definitely be considering investing in this company because it is one of the strongest, if not the strongest business in the world today. They are perfectly set up for the boom that is happening, and it's just a matter of, are you willing to pay for it at this price? But with that, you are seeing other interesting companies like CrowdStrike. Again, really solid growth rate. The thing is that they have a negative 5-year return on invested capital and profit margin. So what this is showing is that within that time, at least once, but maybe more likely a few times, they have actually posted a loss for the year. And so when I would look at a company like CrowdStrike, it would be like, well, it's fantastic to see that level of growth, but I want to ensure that there's that sustainability that is tied to it as well. And what that simply means is that what I want to see over these coming years is that a company like CrowdStrike is able to generate a profit consistently and be able to do so at a high clip. If they continue to lose money on a yearly basis, there's just better options out there. And like I already talked about, Fortinet is an alternative in the cybersecurity space that has already proven that they are profitable consistently and they have an attractive valuation. Whereas on top of it, CrowdStrike right now has a $111 billion market cap. They only have what I think is a $64 billion valuation. So they have a higher market cap than Fortinet, even though Fortinet here has a 46% ROIC, a 21% profit margin, 25% growth rate, and less debt and a more attractive valuation. So this is why I compare. This is why it's good to have multiple companies in the same industry, because you can decide who truly is the best of the best. So with that, I do want to show quickly debt because I think it's one of those that gives you a good idea. But here's what you're saying is that I have found 28 companies that have a debt to free cash flow of 0%. meaning they operate with zero long-term debt. And I think it's only fair to read through them all just so you can see them. This is the gold standard. If you can operate with no debt and still generate high amounts of profit and growth and achieve everything that you want to without taking on additional risk, then you are built to last. And that is exactly what we're seeing here. So I'm going to read through the list of all these companies that have zero long-term debt on their balance sheet and are built for the long term. With that, we have Pinduoduo, Shopify, Houlihan Lokey, Arista Networks, Palo Alto Networks, Copart, Logitech, Badger Meter, Cal-Maine Foods, Red Violet, Chipotle, Excelis, Clearfield, Ulta Beauty, Bank 7 Corp, Iradamed, Primerica, VIP Shop, Intuitive Surgical, Moelis, Berkshire Hathaway, First American Financial, Robert Half Insurance, USANA, Medifast, Perion Network, and Snowflake, Natura Lifestyle Holdings. So 28 companies, all no debt on their balance sheet. They are positioned for the long run, and they are built to really endure any economic headwinds, at least over the next 10 years. We'll definitely have to keep tracking that, but all a really good sign. And if you compare that with the other financial metrics plus the valuation, you have found the gold standard when it comes to investing. So now that we've covered the financial metrics, you've gotten a good idea of what's out there, the top 10 list within each of these that I track. Now we can move on to the valuation side of things and see what are the most attractive purchases today. Beginning with free cash flow yield, these are the 10 most attractive stocks based on their valuation from this standpoint. At number 1, we have Afia with a 37% yield. Number 2, Euroseas with a 33% yield. Cal-Maine Foods at number 3 with a 29% yield. At number 4, Snowflake with a 21% yield. At number 5, Arch Capital with a 20% yield. At number 6, Netflix with an 18% yield. At number 7, RBC with a 16% yield. At number 8, Canadian Tire with a 15% yield. At number 9, Travelers Company with a 15%. At number 10, Credit Corp with a 15%. So once again, free cash flow is essentially the free cash flow that they produced in the previous year compared to their market cap today. Anything above 10% highlights that if you purchased at this price are expected to generate that return, and it's definitely a useful measurement that gives you a good idea. The higher it is, the more attractive the valuation is at this time. And if you compare that with how I value companies, then you get this whole all-encompassing idea of what a business is worth and whether it is a good investment at that time. And so with that, I think it's only fair. Let's look at the actual over-under and see what the valuation is based on what I think the company should be purchased at compared to the market cap today. As I said, after looking at free cash flow yield and seeing the high yields that exist out there, pairing that with an over-under that is just as attractive really indicates whether the stock is over or undervalued. And in this case, we are looking for undervalued businesses. With that, the top 10 most undervalued high quality stocks in the market today are at number 1, Afia, at number 2, Medifast, at number 3, PDD Holdings, at number 4, Cal-Maine Foods, at number 5, Arch Capital, at number 6, Salesforce, at number 7, Netflix, at number 8, Perion Network, at number 9, DR Horton, and number 10, VIP Shop. You are seeing that from the top of the list, Afia is 94% undervalued, and at the bottom, VIP Shop is 56% undervalued. There are a ton of undervalued stocks out there. You just got to go look for them. There's a lot of high quality to go with that. And when you can combine those two, you can really see that they built the business to endure no matter what comes their way. I also think it would be interesting just to look at the largest market caps that I track, and then also even perhaps the smallest ones, so that you can kind of see the range of companies that I look at. And then we can also look at the valuations that are tied to those businesses. And I'll show you again what I think deserves the highest valuation in the market, as well as what exists on the low end, so you can see that and get a full perspective. So first, with market cap, the top 10 companies with the highest market cap that I track are number one, Nvidia with a $4.6 trillion market cap. Number two, Alphabet with a $4.4 trillion market cap. Number three, Apple with a $3.8 trillion market cap. Number four, Microsoft with a $3.4 trillion market cap. Number five, Amazon with a $2.6 trillion market cap. Number six, TSMC with a $1.8 trillion market cap. Number seven, Broadcom with a $1.7 trillion market cap. Number eight, Meta with a $1.6 trillion market cap. Number nine, Tesla with a $1.4 trillion market cap. And number 10, Berkshire Hathaway with a $1 trillion market cap. So what you're seeing here is 10 companies that I track with above $1 trillion market caps, massive businesses. They have been in massive runs over the past decade and beyond. And these are clearly the largest, the most dominant market leaders out there today. Will it last? Do they deserve those valuations? That's a question for another time. But for now, these, as of 2026, are the biggest companies out there that are at least worth following. Now, from there, we will now look at the flip side of that and look at the smallest businesses I track. So after looking at the business companies that I follow, here are the top 10 smallest companies that I track. It just goes to show the range of companies that are out there that are high quality and worth following. And as you can see here, at number one is Medifast with a $130 million market cap. At number two, Euroseas with a $377 million market cap. At number three, Bank7 Corp with a $400 million market cap. At number four, USANA with a $400 million market cap. Number five, Clearfield with a $440 million market cap. Number six, Perion Network with a $454 million market cap. At number seven, Afia with a $655 million market cap. At number eight, Red Violet with a $700 million market cap. At number nine, IRadimed with a $1.3 billion market cap. And number 10, Himax Technologies with a $1.5 billion market cap. So don't discount a business based on size. There are a lot of high quality businesses out there. These are a few of the companies that I believe are worth following. And now that we've covered that, the last piece of this whole puzzle is what I think these companies are worth. And so in this case, what I'm going to do is highlight the companies that I believe deserve the highest valuations out there today, as well as those with the lowest valuations. And again, it's all relative. If it's a small company and it has a small valuation and it's below what the market cap is, that is still as attractive as an investment as a $1 trillion company that deserves a $2 trillion valuation. So companies that deserve the highest valuation in the market today are at number one, Nvidia with a $2 trillion valuation. At number two, Meta with a $1.5 trillion valuation. At number three, Amazon with a $1.4 trillion valuation. At number four, Alphabet with a $1.4 trillion valuation. At number five, Microsoft with a $1.3 trillion valuation. At number six, Broadcom with a $1 trillion valuation. Number seven, PDD Holdings with $891 billion. At number eight, Apple with $890 billion as well. And number nine, Salesforce with $638 billion valuation. And lastly is TSMC with a $600 billion valuation. Massive companies that also deserve massive valuations and definitely worth checking out. Lastly, we are going to look at, on the flip side of it, the smallest valuations that I track. And here, the top 10 list of companies with the smallest valuations are first at number one, IRadimed, $193 million. At number two, Clearfield with $380 million. At number three, Red Violet with $390 million. At number four, Euroseas with a $764 million valuation. At number five, Bank7 Corp with a $782 million valuation. The same is true for number six, USANA. At number seven is Medifast with a $922 million valuation. At number eight, Perion Network, $1.2 billion. At number nine, Norfolk Southern with a $1.4 billion valuation. And lastly, at number 10, D-Local with a $1.6 billion valuation. So we are looking at companies that have $2 trillion valuations all the way down to $200 million. The range is very wide. There's quality to be found in all corners of the market. You just have to go look for it. And this is a prime example. Tie that with quality and value, and you find yourself a golden stock or investment opportunity that is worth your while. So now that we've gone through the list, I've highlighted many of the different businesses that you can go and explore. The idea is to capture as much information and to really expose yourself to what is out there so that you can see that there are opportunities in all facets of investing. You just have to go look for it, find quality opportunities, and you can make it happen. And since we've looked at everything, now the last piece is to put it all together and to see who stands at the top when it's all said and done. So piecing it all together, looking at return on invested capital, profit margin, growth rate, debt, and the valuations of these businesses. The top 10 companies as of the second week of January 2026 are at number 1, Bank 7 Corp, a new leader on the list. At number 2, Euroseas. At number 3, Catalyst Pharmaceuticals. At number 4, Cal-Maine Foods. At number 5, Copart. At number 6, Fortinet. At number 7, Medifast. At number 8, Regeneron Pharmaceuticals. At number 9, NVIDIA. And number 10, Arista Networks. Top tier companies, high ROICs, high profit margins, growing at a good clip. Most importantly as well is an attractive valuation. This is what you will find in these 10 stocks. And as this list unfolds, make sure you like and follow. I can't wait for next week. I think this is going to be a big one in terms of really diving in and seeing how things develop. I'm going to have this full list built out. We are really going to see the whole picture of where things stand today. Once again, if you've hung out this long, thanks a ton for watching. Thanks for following. Thanks for liking. It really goes a long way, and I can't wait to continue growing this thing with all of you. I look forward to the next one. Peace.